everyone. It's been a while since I recorded a video to be a part of my tax help video series, which I think consists of approximately 35 different videos regarding various tax topics. Well, I decided that it was time to get back on the scene and record another video for you guys. So the topic of this video is the Tax Cuts and Jobs Act changes for individuals. Now, there were many changes brought about because of the Tax Cuts and Jobs Act, TCJA, otherwise known as the new tax reform. But in this video, I'm going to discuss some of the relevant changes that affects individuals. I may be recording a video that discusses the changes affecting businesses as well. But again, this particular video is going to reference some, not all, of the individual changes that came about because of the Tax Cuts and Jobs Act. So, I'm going to be reading from a summary that I have. So if you're seeing me turn away every now and again, that's because I'm looking down at a sheet of paper. Of course, this is too much information to try to memorize, so I'm not even going to try to go there. Okay, so let's get started here. As you all know, on December 22nd, 2017, President Trump signed the Tax Reform Act, or the TCJA Act of 2017, Tax Cuts and Jobs Act. Again, many changes were brought about because of this Job Act, and these changes will undoubtedly affect many individual tax filers as well as some business tax filers. So, but again, I'm just going to talk about the individual tax filers in this particular video. So let's start with the tax brackets. So the tax brackets have changed because of the Tax Cuts and Jobs Act, TCJA. So in 2017, the tax brackets were 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. For tax years 2018 through 2025, the tax brackets are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Why 2018 through 2025? Because December 31st, 2025 is when some of the changes sunset for the TCJA. So if you hear me refer to tax year 2025, that's the sunset date, December 31st, 2025, which means after that date, things will go back to the way they were prior to the signing of the TCJA. Okay, so that was the tax brackets there. Again, the new tax brackets for 2018 are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Now, as a result of the TCJA, personal exemptions have been eliminated, which means that $4,050 that you got for 2017 per exemption, it no longer exists. At least not until after 2025 anyway. So that was eliminated for tax years 2018 through 2025. Now, the standard deductions did increase, so that might help in a sense kind of replace the personal exemption deduction, at least for some, maybe not all. So I will talk about the standard deductions a little bit later. Actually, you know what? I can go ahead and talk about it now because it's sort of like right here in front of me. Okay, so for tax years 2018 through 2025, the standard deduction amount for a single tax filer is now $12,000, almost double what it was last year. And this $12,000 is for single tax filers and married individuals who file separate tax returns. Head of household, the standard deduction is now $18,000. And for married filing jointly, the standard deduction is now $24,000. Okay, so again, the standard deductions for tax years 2018 through 2025 are as follows. Single tax filer and married filing separately, $12,000. Head of household, $18,000. Married filing jointly, $24,000. Okay, so let's move on to family tax credits. Let's see what they say about the family tax credits here. Okay, so the child tax credit has increased to $2,000 per child under age of 17. For tax year 2017, it was $1,000. The maximum amount refundable of that credit is limited to $1,400, $1,400. And under the TCJA, the credit doesn't begin to phase out until the adjusted gross income exceeds $400,000 for married couples or $200,000 for all other filers, compared to 2017, the phase-out thresholds of $110,000 and $75,000. Also, the TCJA includes a non-refundable credit for qualifying dependents other than qualifying children. For example, a taxpayer's 17-year-old child or elderly parent. And that amount for that non-refundable credit is $500. Okay, so now let's talk about above-the-line deductions here. Okay, so let's see here. What do we have here? Moving expenses. Unfortunately, if you were hoping to deduct moving expenses between the years 2018 and 2025, forget about it. Not going to happen. That expense has been suspended for tax years 2018 through 2025. You used to be able to write off moving expenses if you moved a certain amount of miles away from a job for another job. But again, for tax years 2018 through 2025, that's not happening. Okay, alimony payments. For those of you who are planning to get divorced this year or next year, you might want to listen to this. For divorce agreements executed or in some cases modified after December 31st, 2018, alimony payments won't be deductible and will not be taxable to the recipient. Because the recipient spouse would typically pay income taxes at a rate lower than that of paying the spouse, the overall tax bite will likely be larger under this new tax treatment. And this change is permanent. So, don't try to stick around in the marriage until 2025 thinking that afterwards it's going to be deductible. Based on this information, that's not going to happen. It's a permanent change. All right, so let's talk about itemized deductions. So, when you file your tax return, you can either claim the standard deduction or itemized deductions. The TCJA limits or suspends many itemized deductions, such as the miscellaneous itemized deductions, which consist of unreimbursed employee expenses, tax fees, anything that's under qualified as a miscellaneous itemized deduction that has been suspended. So let's take a closer look at the itemized deductions. State and local tax deduction, referred to as SALT, S-A-L-T. The deduction for state and local taxes had been proposed elimination under tax reform. It survived, however, it has been scaled back substantially. For tax years 2018 through 2025, taxpayers can claim a deduction of no more than $10,000 for the aggregate of state and local property taxes and either income or sales taxes. So that means that if you have property taxes and other taxes that fall in that arena, $10,000 is your maximum, at least for tax years 2018 through 2025. Mortgage interest deduction. The TCJA tightens limits on the deduction for home mortgage interest. Again, for tax years 2018 through 2025, it generally allows a taxpayer to deduct interest only on mortgage debt of up to $750,000. However, the limit remains at $1 million for mortgage debt incurred before December 15, 2017. All right, let's talk about the home equity interest deduction, the HELOC deduction. The new law suspends the deduction for interest on home equity debt for, again, tax years 2018 through 2025. However, home equity debt interest might still be deductible if the funds are used for a purpose where interest otherwise may be deductible, such as for home improvement, investment, or business purposes. Next on the list is the medical expense deduction. Qualified medical expenses are deductible only to the extent that they exceed the applicable AGI threshold, which is 7.5%, which means that you are unable to deduct medical expenses that do not exceed 7.5% of your AGI. So I mentioned miscellaneous itemized deductions subject to the 2% floor earlier. I didn't mention the 2% floor, but I did mention the miscellaneous itemized deduction. So this deduction for expenses such as certain professional fees, investment expenses, and unreimbursed employee business expenses is suspended for tax years 2018 through 2025. If you're an employee and work from home, this includes the home office deduction. That's if you're an employee that works from home, not for a self-employed individual such as an independent contractor. So don't get confused on that. All right, moving right along here. Let's see what's happening with the charitable contribution deduction. Again, tax years 2018 through 2025. The limit on the deduction for cash donations to public charities is raised to 60% of AGI from 50%. However, charitable deductions for payments made in exchange for college athletic event seating rights are eliminated. Okay, so got to fix my glasses here. Don't want them to fall off in the middle of this recording. So, all right, next on the list is the elimination of the AGI-based reduction of certain itemized deductions. Under pre-TCJA law, if your AGI exceeded the applicable threshold, certain deductions were reduced by 3% of the AGI over the threshold, not to exceed 80% of otherwise allowable deductions. For 2018 through 2025, the reduction is suspended. All right, so let's talk about AMT here, alternative minimum tax. The AMT is a separate tax system that limits some deductions, disallows others, and treats certain income items differently. The top AMT rate of 28% is lower than the top regular income tax rate, but it typically applies to a higher taxable income base. So if your AMT liability exceeds your regular tax liability, you must pay the AMT. The TCJA temporarily reduces the number of taxpayers who will have to pay the AMT by increasing both the AMT exemption amount to $109,400 for married couples and $70,300 for singles and head of households, and $54,700 for filers married filing separately. And the AMT exemption phase out thresholds to $1 million for married couples and $500,000 for all other taxpayers other than estates and trust. These amounts apply for 2018 and will be annually adjusted for inflation until the provision expires after 2025. All right, let's talk about the kiddie tax here. What's happening with the kiddie tax? Under pre-TCJA law, when the kiddie tax applies, all but a small portion of a child's unearned income is taxed at the parent's marginal rate, if higher, defeating the purpose of income shifting. The kiddie tax generally applies to children 18 or younger, as well as to full-time students aged 19 to 23, with some exceptions. The TCJA makes the kiddie tax even harsher by getting tongue-tied here. The TCJA makes the kiddie tax even harsher by taxing a child's unearned income according to the tax brackets used for trusts and estates, which are taxed at the highest marginal rate, 37% for 2018. Once 2018 taxable income reaches $12,500. In contrast, for a married couple filing jointly, the highest rate doesn't kick in until their 2018 taxable income tops $600,000. In other words, in many cases, children's unearned income will be taxed at higher rates than their parents' income. Okay, so let's see here, some other important changes. Roth conversions, which is referring to a Roth IRA. Beginning after December 31st, 2017, the TCJA prohibits taxpayers who convert a pre-tax traditional IRA into a post-tax Roth IRA from later recategorizing, that is, reversing the, let's see what the next page says. Reversing the conversion. Okay, so next, moving right along, the 529 savings plan. 529 plan distributions used to pay qualifying education expenses are generally tax-free. For distributions made after December 31st, 2017, the definition of qualified education expenses has been expanded to include not just post-secondary school expenses, but also primary and secondary expenses. So I'm going to go ahead and read that again. 529 plan distributions used to pay qualifying education expenses are generally tax-free. For distributions made after December 31st, 2017, the definition of qualified education expenses has been expanded to include not just post-secondary school expenses, but also primary and secondary school expenses. Oh, let's talk about the individual mandate now. That's that health insurance penalty. The TCJA eliminates the individual mandate under the Affordable Care Act requiring taxpayers not covered by a qualifying health plan to pay a penalty. And this is effective for months beginning after December 31st, 2018. So basically that penalty is still in effect for 2018, but after 2018, it's gone. So if you can't afford or you just don't want to purchase health insurance, that's okay. You're not going to get penalized for it after December 31st, 2018. Okay, so last but not least on the individual changes, impact on an estate plan. One thing that the TCJA doesn't do is repeal the federal gift and estate tax as originally proposed. It does, however, temporarily reduce the potential impact of these taxes. So, for the estates of persons dying and gifts made after December 31st, 2017 and before January 1st, 2026, the gift and estate tax exemption and the general skipping transfer GST tax exemption amounts increase to an inflation-adjusted $10 million or $20 million for married couples with proper planning. And so just because the possibility of federal estate tax liability sounds remote for most families, it doesn't mean the end of estate planning as we know it. It is also important to keep in mind that the exemptions are scheduled to revert to their previous levels in 2026. And there is no guarantee that a future Congress won't reduce the exemption amounts even further. However, the currently high exemptions increase planning opportunities that can help you shield your wealth against tax changes down the road. Okay, so this pretty much covers it for the individual tax changes that has occurred as a result of the TCJA. So again, I may be recording a video relating to the business changes. So this concludes this discussion. Thank you for listening.